All right, Ben Beck
What?
here.
What's it ready?
Hold on.
Are we doing this?
Yeah, we're doing this. Ben Beck here, Matt Marizio, the Beck Bodie No Bonds podcast. It is a brand new year, 2020. Lots of great things happening. Oh, I don't even know where to start.
Let's start by naming our Instagram handles.
Oh, right.
It's a good way to start. You can find me at Matt Marizio on Instagram, probably most active there, at BenBeck3333. You can follow the company at Beck Bodie.
And email us at social at Beck Bodie. That's important.
Yeah, we always love to hear, we do this so that we can empower people to make better decisions with their money. Mm-hmm. And if we can get emails, which we have, and those are always the best, because the emails say, hey, I would love it if you could expand on blank point. Mm. And then we know that what we're talking about actually is relevant to at least one listener, and that's kind of sometimes all that matters. If one person changes the course of the trajectory of their life, kind of like the old rocket analogy, if the rocket changes 1 degree, eventually it completely either hits or misses its intended target. So if we can help people today change something even by 1 degree, 25 years is going to look a whole lot better for them. So send us an email, social@beckbodie.com. On to 2020.
2020.
Yep.
How was 2019 for you?
It was a good year. It was for me. I have
professionally, personally, spiritually.
There's going to be
the whole thing.
Yeah, I mean, in the beginning of year, every day basically, I kind of categorize my life in 4 buckets, buckets you can call them, pillars, however you want to say it. And I use F's because it helps me remember them all. Finance, fitness, faith, and family, in no particular order. Well, actually, the order should be faith, family, finance, fitness, or fitness, finance. And I guess the last 2 can be interchangeable, I suppose. But I categorize my life goals in those buckets, and I set goals in them, and really it actually, that structure and what would feel like the confines of having your life restricted to 4 areas actually creates a whole lot of freedom for me, because it makes it easy to say no to things that I know don't line up with any of those 4 buckets or the goals within them. And it also helps me definitively say yes to things that I recognize, yes, that will help me accomplish whatever that goal is.
It's empowering.
Yeah, it's empowering.
Makes the ability to make conscious choices.
Yeah, exactly. Knowing that there's an intention to those decisions. Everybody talks about the power in saying no, and how do you say no, and it's so difficult to say no. When you have really clear goals and really clear direction where you're trying to take things, no doesn't get that hard. No. There are very few gray area no's in your life. So you just have to do it, and you have to stick to it. So ask me how 2019 was. 2019 was overall a really good, really encouraging year. I would say that the majority of those goals were hit, not all of them. But I know myself. I know that I will never be satisfied, but I've learned to be happy without being content. So I recognize, let's say I accomplished a goal. Maybe I blew a goal out of the water. I'm excited, I celebrate it, and then I move on and reset the goal. Previously in my life, I didn't even take a minute to celebrate it. I didn't even acknowledge or recognize that I hit a goal and I did something I set out to do. It was more like, if I hit the goal, I know, that's why I wrote it down. It was a goal, I expected to hit it, now I hit it, now I'm moving on. And I never even gave myself the credit of hey, nice job. And it's so much more important, I've learned, to do that, because then you're not constantly just thinking about next. You can actually enjoy the present.
Yeah.
How about you? Yeah. How's 2019 for you?
2019 was great. 2019 and going into 2020, I'm a big, I think in so many words that just came through with what you said. I'm really big on personal growth. You know, from a professional standpoint, from a communication standpoint, family, everything, you know, under those 4 F's, so to speak. But the personal growth part is every day coming into a better understanding of who I am, what I'm here to do, from a business, from a family perspective. It was a great year. We professionally, Beck Bodie grew as a company substantially. More important than the growth was the people that joined us. I mean, you've been here more than a few years now, and but we've added some just great people to the organization, which to me is the barometer of the health and the success of the organization. You know, of course, we've said it many times in this podcast too. We're a company that is very family oriented, and the emphasis, the time over 2019 that we all spent with our families, and in me particular, it has been great watching the kids grow and spending time with clients, really engaging with clients, and helping them work towards their objectives. It just gets me more excited for all of that engagement in 2020 and all the opportunity that's out there. Awesome. So what are we talking about today?
Well, let's jump on that goal bandwagon for 2020. You know, I don't necessarily want it to be a goals-based podcast. You know, like write your goals down, wake up early, read books, all that stuff. Although I do those things, those aren't necessarily recommendations. But what I thought would be cool to speak about and talk to people about today is what can you think about from a financial perspective for 2020, right? If you could grab dinner on December 31st, on New Year's Eve, 2020, and you were reflecting on the financial part of your life, what can you look back at and say, man, I'm glad I did and I started those things in January. And what are those things? So I think, there can be any number of them, but let's give 3 recommendations. 3 seems like the most palatable number for the human mind to comprehend in one sitting. So, and we can go, all right. So I think primary goal number 1 is start investing despite what may or may not be muddying your head in terms of fear, anxiety, emotion, uncertainty to the market.
So
just start. Do it.
Right. Just start.
If you haven't started, or keep going, and don't worry about pulling out, timing it if you're in it.
Right. So that really doesn't matter the audience in that sense, right? I mean, if you're 20-something that doesn't even have an account that you're putting money in, or you're 50-something who might have accounts but aren't actively putting more money away, put money away. Start. You know, best way to start is just to start. Right?
Take a step forward.
Take a step forward. I think that's really important. I think I think you used the word fear and uncertainty a minute ago. We're 2020. It's a question we get a lot. Okay, you know, it's election year.
Yeah, exactly.
So there's going to be a lot of volatility, I think.
Right.
I'm not really, that sounded sarcastic, but I don't know. Okay, then if I say yes, okay, so 2018 was a volatile year.
Right.
It wasn't an election year.
No.
You know, in 2018, the fourth quarter alone, the S&P 5 fell, the market fell just about 20%.
Yeah, from high to low.
From high to low in the fourth quarter, like Christmas Eve, I think was maybe the first up day, or the bigger up. So
that was the worst December since the Great Depression. How about that?
I didn't know that.
For a fun fact.
Oh wow, fun fact.
Yeah. Well, the internet said that on multiple places, so whatever's written on the internet is true.
Don't believe me, Google it. Yeah. So that's interesting. I didn't know that fact, but so you hear, I guess, as those words come out of my mouth, you hear all these sound bites all the time, right? About don't sell in May and go away, or
right,
or October is the worst month to invest.
That's right.
Or it's an election year, it's going to be really volatile, you want to stay away. I don't know. I have no idea. All I know is that if you look back at election years, you could say, oh, some of these were somewhat volatile years, but then if you're not comparing it to anything else, then it really holds no water. And you look back at other years that aren't election years, there has certainly been many years that have been volatile that weren't election years. So I guess that doesn't hold any water to me.
Right.
And certainly, regardless if it turns out to be a volatile year or not, that should not in any way, shape, or form hold anyone back from starting. Or if you've already started and you have accounts, continuing.
Yep.
Not what I mean by that is not saying, oh, I'm going to take a break for a second because it's an election year, or there might be some volatility.
Right.
I think that hurts a lot more than it helps.
It definitely does. So I'm gonna reinforce that point with two things. One, last year I'm gonna throw out in my head. I'm recalling some of the headlines last year. There was a China trade deal.
Sure.
Trade wars, real issues. There was inverted yield curves that was throwing everybody off, saying like time to get out of stocks. There's gonna be issues. Yeah. There's impeachment conversations toward the end of last year. Last year the market returned something like 30%. It's one of the best years in the history of the market. And all throughout the year there were headlines of an impending crash, right?
Right.
Let's also reinforce it with this point. So, point there, if you were reading the headlines last year, you would have wanted to jump out. As well as the last decade, there was headlines like that. The point is, the news headlines sell because they're dramatic. So don't listen to them. Ignore that. The other point is, you got into this business in 2004, right? Do you remember the Dow? What the Dow might have been at around then?
Right, 11,000.
Okay.
Maybe a little bit shy of that.
So shy of 11,000. 2004 was well before one of the worst economic catastrophes in 2008, 2009. So you were before that. Now where the Dow's touching 30 almost, right? 30,000.
Yeah.
So nearly a 3x growth in just the Dow.
Right.
Despite, plenty of uncertainty throughout the way.
Yeah.
There were multiple elections. There was a recession. There was the longest 10-year run. I don't know if I'd say the best, but a longest bull market.
So don't start because we come off a huge year in the markets, because obviously the next year after a huge year it's going to be down because the market is overblown or too overheated. 2008 and 09 was peak to trough, I think down 54%. Yet I got into the business, the Dow Jones was at 11,000 or shy of that, and now even we've gone through a time period only 4 or 5 short years later after I started, of that huge decline, catastrophe in the markets, as well as a number of corrections along the way. The Dow is now at I think 29 and change as we speak. So I don't, to sit here and say we have an idea of what's going to happen next week or next month or even over the course of the year. We certainly have our feelings. Regardless of what our feelings are, again, it all kind of points back to that should not impact any decision about getting started or continuing in your investing. Because at the end of the day, not knowing what's going to happen over the next year or even 2 years, if you look back over my career, or let's go back a little further over the history of the market. While it's not a straight line, I don't know where the camera's going to show this, by the way, but maybe it's this way. I don't know. But from this is the beginning, or this is 10 years ago, or this is 20 years ago, 30 years, a starting point, the line trends up in terms of growth. So, if you've got any kind of long-term horizon, which I would submit every investor does.
Unless you're 85 listening to this. Maybe.
I'll qualify that. Most investors that will be watching this have a long-term a long time period, enabled to be able to invest. The election years, the U.S.-China rifts in terms of trade,
missiles in the Middle East.
Missiles in the Middle East right now, or coming off a great year in the markets. Those should not prevent or sway your decision making in terms of when to invest. Just invest.
Yep. Just invest. Take the step.
Because the only thing for a long-term investor that's going to get in the way of achieving success or in your financial goals is not being invested, or at least the major thing is not being invested and not consciously putting money away and taking advantage of the runway, the amount of time that you have. You could invest tomorrow, and it could turn out to be the exact wrong time to invest in the context of what's going on in the world right now. That's totally hypothetical.
Right.
But we can invest tomorrow, and we tell all clients that when they get started, it says, hey, look, your $1 million or your $100,000, we could be talking 6 months from now, and it's down 25%.
Right.
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 That's okay. Quantify that. Okay, $1 million is now down to $750,000 in 6 months' time. That is, I wouldn't call it a normal correction. Correction is loosely defined as any fall in the market of 10% or more, and we've had plenty of those. The deeper ones are, when you start to get to 20 and 30 and so on.
Right.
But they tend historically to be very short-term in nature. And as I said, the starting point of when you invest, the markets trend upward.
Yep.
And that encompasses the downtimes of the market, that encompasses everything. So it's not so much of you and I saying this is the right time or wrong time to invest. We're looking at things from a bigger picture scenario, and we don't know what's going to happen. Nobody knows what's going to happen over the next, but we know that the bad times in the market tend to be quite short in terms of time,
and far less frequent than the good times.
Exactly. So get started.
Yeah, get going. Point one, goal one, get started. All right, number 2, think about Roth IRAs or Roth 401ks, the Roth option. So quickly we'll define a traditional IRA, a traditional 401k. The money goes into that account before you pay any taxes, so you haven't paid a dime in taxes yet, and then eventually, by the time you're 70 and a half, you have to, actually 72 now with the new Secure Act, but eventually you're going to be required to take that money out and pay tax on it, right? So at some point in the future, you're going to pay taxes. The difference with a Roth option, everything else stays the same, everything else being equal. You pay with a Roth, you pay the taxes today at your current income tax bracket, whatever that rate is, and then you'll never pay another dime in taxes again on it. Now, what we're saying is think about that Roth now in particular, because this new tax environment we're in with the Tax Cut and Jobs Act, we are, relatively speaking, despite what the media may say or what your emotions may say, we are in a relatively low tax environment. The first $300,000 or $400,000 of married income brackets really don't exceed 24%. So there's a huge opportunity to pay a lower tax now than what will probably be, because in January 1st, 2026, when this current tax act sunsets, we're almost guaranteed that the tax rates will go up somehow. So,
and that goes for if you're a 25-year-old, maybe brand new to the workforce, or just looking for the right place to save money. Roth IRA or Roth portion of your 401k.
Yes, good point. Check. So part of that, what you should put on your to-do list is check if you're working for an employer that offers a 401k. Check with your HR department or whoever sponsors that plan to see if there is a Roth option. Some people have Roth options to contribute Roth dollars to their 401k plan. They don't even know it exists. It's not clearly defined.
Right.
But go seek it out. Ask, okay, is there a Roth option on my 401k?
Yeah, take advantage of that, because the ability, especially with the longer of a runway that you have, the ability to not have to pay tax on that money when you go to take that money out at retirement or whatever point past that is and can be just tremendous.
Yeah, and solo business owners, we were talking about this earlier.
Yeah.
A typical retirement for a solo business owner is a SEP.
SEP IRA.
Yeah, people open up SEP IRAs, which are pre-tax dollars.
This is typically for a sole proprietor that has no employees or very few employees.
Yeah, you almost always it's no employees, or maybe they have a separate business that has employees or something with it. Yeah, so it's a no employee business typically is what we're talking about. But if you have that, our recommendation is think about a solo 401k, because with the solo 401k, you can add a Roth option.
Absolutely.
And given this current environment, it's going to be hard to beat that, at least in the next, I don't know, in the future. Like we can't predict what the future looks like, but I think it's safe to say for a while, tax rates might be worse than this.
And yeah, and if you don't have any employees whatsoever, obviously a solo 401k, that's who it's for. You can put a lot more money away than in a solo 401k as you can typically with a SEP IRA.
Yeah.
In most cases.
Yeah, you can put up over $50,000 away eventually. Ultimately,
$7,000.
This
year.
That's what it boils exactly.
Yeah. And back to the Roth IRA discussion.
Yeah.
And you know, I think we just used the example of the 25-year-old, but so the 50-year-old, maybe your kids are getting into college and you're working. Consider it at minimum the Roth portion of the 401k.
Yeah.
Yes, what that means is, because maybe we should take a step back for a second and to talk about how money flows into a 401k. Most people that have a 401k know that they're called deferrals. So they call payroll deferrals, where you set up with HR or you go online on the 401k company, and you dictate how much of your paycheck every biweekly period, every month, or what have you, goes into the 401k. Those funds get deferred to the 401k. Those funds get deferred into the Roth side of the 401k. If you're doing the traditional 401k, that means that taxes are not withheld from there. In other words, what that means is the contributions you make are considered pre-tax, and they come essentially right off of your income. So you benefit from an upfront tax advantage right off the bat. With the Roth side of the 401k, you don't. Though that money goes right in, it shows up in your pay stub, so to speak, in terms of being taxed at payroll. And that after-tax money is another way to say it, goes into your Roth 401k. So you end up starting with after-tax a little bit less money than you would with the traditional 401k. But the idea here is, over a certain amount of time, in considering that with the Roth side, you don't pay tax on that money when you go to take that out in retirement, versus with a traditional, you have to pay tax on that when you go to take that out. It could be a great situation for you at that time. We certainly feel would be a great situation, not have to pay tax on that money at all. A tremendous amount of flexibility.
Yeah, I mean, all cases are individual, but our recommendation here is kind of probably against the grain, where we're telling you pay taxes now, don't defer, pay them now, because you're in a pretty good tax environment. Take that one last step further, is if you have a large bulk of your money in a current IRA, let's say you had a few other jobs, you're 55, you're approaching retirement, you rolled them over, you rolled them into all your old 401ks into one big IRA. We would encourage you to consider, you would have to analyze this if it makes sense first, but you might want to convert those IRA dollars into Roth dollars, meaning convert them over time, over the next 5 years, right? Unless the tax environment changes before that. Convert them over, incur the hit now on taxes, because it's very likely, if you're 55, let's say you're going to retire pretty soon, that you can pay the tax now, and you can be willing to bet that your early years of retirement, your tax bracket's going to be pretty high, because the overall income tax brackets will probably go up We don't know to what extent, but consider converting existing IRAs into a Roth IRA by paying taxes this year. There are rules to that, so I wouldn't recommend you do that. Just go and do it willy-nilly. I would seek a professional on that, but that's something to put on the to-do list, I would say, for January.
I'll wrap up the Roth IRA conversation with one more point, is that a lot of questions that we get are, geez, I've got money building up in my savings account, and I don't know, Matt, what account should I put it in? Obviously, we're talking about the Roth IRA. How much should I put in? Well, there are limits to that, obviously, with the Roth IRA.
Yeah.
But one thing to know is the Roth IRA is a pretty safe vehicle in terms of flexibility, meaning money that you have in your savings account, and let's say you're younger, you want to start a Roth IRA. For 2019, I know it was $6,500, correct? So what's the limit for 2020? Do you know? I don't know.
6,000 was 19, I thought.
Oh, no, okay.
Yeah.
I'm sure it was indexed in some way to make up, but let's call it 6,000. All of the contributions that you make to a Roth IRA, you can actually take out at any time. It's only the appreciation, if you touch that appreciation before you retire, that the IRS will penalize you on and actually make you pay tax on. So one of the flexibilities of the Roth IRA, which we've actually talked about in the past, is that you can get your contributions at any time if you need to use those. Now, obviously, the point of any kind of retirement account is to put money in today for the purpose of retirement, for the purpose of letting that work for you, be invested over a long time period, so it grows to the goal to grow to great, unbelievable
infinity.
Infinity is good, but one of the concerns for particularly a younger investor too is, geez, I've got some money built up, I don't know what to do with it. Okay, you say open up a Roth IRA, but how much do I put in, and this and that, and can I get at it? The answer is open up the Roth IRA, invest that money for the long term. Yes, you can get at it if you actually the contributions without penalty if you need to.
Yep, agreed. Love it. Last recommendation for January 2020 financial outlook for you. We encourage people all year long, but January is a great time to really go ahead and do a deep dive into your finances, meaning figure out what money's coming in and figure out what you're spending your money on, right? Some people call it the ugly word budget. We don't recommend budgeting all day, every day for your entire life, but January is a good idea to get hold of that. I will take that one step further and say, also dive into what you're invested in. There are so many people we talk to on a daily basis that we say, okay, where is your money? What's it invested in? And, like crickets. It's a blank stare back. Like, what? I don't know. I'd have to look. I have no idea what I'm in. To us, we have a lot of conversations with people who are slaves to their money, meaning they have no idea really what's happening to it. They don't feel in control of it, and as a result, they feel like they have to succumb to whatever at the end of the day is left in their bank account. When you can reverse that and you can take control of, all right, I understand what's coming in, I understand what I'm spending on. Even that exercise alone makes you feel better, feel more in control. And then you can look at your investments if you have some and say, okay, what the heck are these mutual funds or these index funds? What are actually inside of these funds? What companies do I own, if you want to? Or do I even like the fact that I'm living in a set it and forget it investment strategy? Does that line up with who I am, how I'm wired? Do I like that? Is there something better? Let me go explore it. Like, go through the educational exercise of understanding and dealing with money and investment.
I'll take it a step further.
Yeah, go for it.
Engage with a certified financial planner, or a firm that does financial planning. Certainly, I think that is probably the best advice. Now, obviously, us being a financial planning and investing firm, that sounds a little self-serving. I didn't say necessarily engage with us. Should engage with us, in my humble, unbiased opinion. But no, there are a lot of quality professionals out there that can help with this. And to Matt's point, it is tremendously important to understand where you are. From a budget perspective, and then equally, if not more, important is once you understand where you are, what you should be doing from a financial perspective to maximize, your ability to hit your goals and objectives in the future. Mm-hmm. Not a lot of folks, not a lot of professionals better at this to help than financial planners that can have the experience to guide you. And more than anything, I'm a certified financial planner. Now I'm amongst 25 other professionals at my firm. But I will say this, in managing my own money, it's important for me personally with my own personal finances to have that dialogue with Matt, to have that dialogue with other people on my staff about my own perspective and my own finances, because it is something that is difficult to do on your own.
Right.
Now the way the financial industry works today with robo-advisors and do-it-yourself, and you can log in and trade for free at XYZ company, that's all fine, but that still leaves unanswered the question of where I am, where should I be. Everybody's different, as you said before. Everybody's got different circumstances, so there is no one size fits all, in my opinion, in our opinion. It's more than anything else, more than the X's and O's, it's being able to have that dialogue with somebody that can relate, that somebody can understand, but secondarily, and more importantly, has the experience in dealing with what you're going through and what your financial circumstances are like, and can give you very relevant, usable information on how to proceed and better your financial condition.
Yep.
So I've done interviews and things like that before. It's just, well, what's one piece of advice you can give to somebody out of all of us? Engage with a financial planner. Engage with a financial planner. Yeah. Because you have to have that understanding of where you are, and you have to have that dialogue. It's so darn important.
So important. What it does and what it did for me years ago when I started was it changed my relationship with money from an unhealthy to a healthy relationship. From seeing money, I'm a slave and a victim to finances, to money's a tool to help me accomplish those goals in those 4 buckets. Mm-hmm. So having the conversation, whether you decide to hire or not hire, talking about it, understanding how to think about it, changes your relationship with it, and that changes the trajectory of where you're going with it.
I love how a conversation like this from start to finish comes full circle, because you talked at the beginning when you're going through this, you're talking about the being able to say no, but the bigger picture of making choices.
Yeah.
And by making choices, you're taking control of the direction that you're going in life, and it is empowering.
Right.
It's powerful.
It's a good word, empowering.
And it puts you, put you in a much stronger position in terms of your decision making going forward. Man, I love it when that comes full circle like that. It's almost like it was planned.
I love that.
It wasn't.
It wasn't, but it was. Happy 2020. Look, let's make this the best year of our lives. 2020.
Let's do that. Yeah. So at Beck Bodie. Yeah, I like that. I like the way that sounds. At Beck Bodie on Instagram, at BenBeck3333, at Matt Maurizio. Social, please do email us. social@beckbodie.com. Even if it's, hey, I've got questions about XYZ, maybe talk about that in a next podcast. We'll happily do that.
Awesome.
But 2020, Happy New Year to everybody, and we look forward to the next podcast.
Yep. Take care.